Good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management, and how all of this impacts our decisions on the best courses of action for your investment strategy and financial goals. We're recording this webinar so that those who can't join us live can tune in when it is more convenient. My name is Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of High Rock, is currently hiking across glaciers in Iceland with his family. And that is certainly one way to beat the heat. But our financial planner, Bianca Tomlinson, is with me on the call. We will have our question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. Remember, if you have a question, it is likely that other listeners may have the same question, so please feel free to engage us. Well, we received some excellent feedback from our listeners last week, and as a result, we have changed the format to our weekly call. Now, if you're a first-time listener and would like a little more information on our private client services, we have a separate webinar that will provide you with this. The recording is on our website on the weekly webinar access page, which is going to be directly under the recorded webinar that we're doing right now. Well, let's get right to what is driving financial markets. We have a number of themes that we have been following regularly through these weekly webinars, and certainly you'll all know the guiding principle for all of this is to expect the unexpected. Well, there have been plenty of surprises this year so far. Volatility spiked last week to levels not seen since 2008 as equity investors became unglued over the situation in China. The declining economic growth and currency devaluation followed by a sharp fall in equity prices added to global investor uncertainty. When investors become uncertain, they hit the sell button, and the wave of selling of riskier assets like equities drove prices to lows not seen since last year. As it stands, most equity markets are lower on the year with the exception of some Japanese and Euro area indices. Now we'll look at a little closer at these further along in the call. Well, one of our themes for 2015 has been continually to suggest that equity markets were expensive. And investors who have borrowed to pay too much for expensive stocks, well, they're usually the first ones out as they get margin calls that force them to sell to pay down their loans. Momentum can build if longer-term investors get spooked and start joining the selling. We've been showing this chart for the last several weeks. We had called for an eventual correction of between 12 and 20%. We really didn't expect it to happen in such a short time frame. But the confluence of events has created some significant selling, and again, we certainly saw that in today's activity. We saw initial support at the S&P 500 in the S&P 500 at about 1865. The subsequent bounce brought us almost back to 2000, but it still remains to be seen if we've actually tested the bottom of this move. We've been right on our call, and we've been making sure that our clients have benefited from this. But we can still afford to be patient. We need to see how these higher levels of volatility will play themselves out. Historically, higher levels of volatility point toward a potential change in the trend. So we're continuing our assessment of markets and what opportunities will prevail. Well, we've been showing this slide every week for quite some time, and basically that's that on an enterprise value to earnings basis, stocks were very expensive. Even with some of the correction, they're still relatively expensive, but certainly a lot less so. With revenue and earnings growth still expected to be negative in the third quarter, the forward 12-month earnings per share data has dropped to the level of 15.2 versus the level of 16.8, which we had at the beginning of May. Now the 5-year average is 14, the 10-year average is 14.1. So we're certainly getting closer to better values, but there's certainly still some way to go to get back to the types of value that we had in 2011 and 2012. Not that we'll necessarily get there, but certainly we think there's still some room to go. And speaking of that, as portfolio managers, we have a long-term perspective, and we certainly believe that markets are cyclical. Many may remember back to the lows of 2009. I certainly do, and the emotional concerns that certainly went along with them. I remember having numerous conversations with clients explaining that we were at cyclical lows at the time. Well, we're certainly off the recent cyclical highs for equity markets. It's not exactly clear how far into the cycle we've moved, but we are monitoring it closely, and we do believe that we will at some point in time find good opportunity down the road. Well, we've also been pointing out that bond markets are our guide to what is coming in equity markets, and we recently noted a few weeks ago that high yield bonds had turned significantly lower, well ahead of the S&P 500, and that traditionally this was a good leading indicator. Well, certainly that played out, and stocks have definitely now jumped ahead of high yield, outpacing them to the downside. Now, on this call, we've talked a number of times about how we think that high yield bonds, especially Canadian high yield, have less volatility than equities, and here is a classic example of that. And it's why we like the high yield asset class in our client portfolios. More diversification and excellent risk-adjusted returns. Certainly significantly better risk-adjusted returns than both the S&P 500 and the TSX. Well, let's check out the inflation watch. Lots of central bankers and economists gathered last week in Jackson Hole, Wyoming to talk about inflation. The conclusion, according to a Bloomberg article, was that at Jackson Hole, and this is a quote, at Jackson Hole, academics effectively delivered a beating to central banks' confidence in their ability to predict and manage their key variable by pointing out wide gaps in knowledge about how inflation works. Well, ouch. So much for what central bankers think, I guess. But where does that leave us? And what are central bankers thinking these days? Well, the U.S. Fed wants to raise rates because they have high expectations that U.S. economic growth in the second half of 2015 will be robust and will warrant a preemptive strike against future inflation. Well, the question is, can they act while a good portion of the global economy is struggling? And we'll look at China as an example. Growth there has been, which had been leading the global economy for many years, is slowing. The latest data on Chinese manufacturing showed a further contraction. Meanwhile, a similar index in the U.S. fell unexpectedly, pointing to slowing of the manufacturing sector there. Current levels of U.S. inflation in the Personal Consumption Expenditure Price Index, which is what the Fed targets, their target level at 2%, continues to remain well below its target, and in the most recent reading showed a level of about 1.2%. So there's quite a gap in what the Fed wants inflation to be versus where it is. And again, the question can be raised is, does that mean the Fed will continue to wait? Now, of course, they're trying to be forward-looking in their expectations. So their ideas of economic growth into the future likely will continue to, or it will likely continue to bring greater inflation, but that's just something we're not seeing at this particular time. And what about the U.S. consumer? It's certainly something we've been following. We noticed in the most recent readings at the end of August that personal income for July was a little bit higher but as you can see, certainly below last year's levels. The consumers, they've been buying automobiles and eating more at restaurants, but spending remains subdued relative to 2014 levels, and consumer sentiment has been slipping in recent months. Well, in the euro area, there are some signs of economic improvement. This morning, they announced that unemployment was at the lowest level in 3.5 years, and inflation does remain stable, but well below European Central Bank targets. In fact, so much so that the European Central Bank is weighing the options of the potential of further quantitative easing. So a bit of a different path than what we're seeing from the U.S. Federal Reserve, interestingly. Closer to home, well, it's official. Canada officially endured a recession in the first half of 2015. 2 quarters of negative growth, but that's history now. The bright spot is that for the month of June, GDP actually grew by greater than expected 0.5%, which could point to a bit of a change in direction. It may be enough to keep the Bank of Canada from dropping rates when they meet next week. And in fact, economists are revising their third quarter estimates for economic growth to a higher GDP number of plus 2.5%. So that's going to be something that we'll be watching closely next week when the Bank of Canada meets. Well, in the UK, like the Fed, with the UK economy growing at the strongest pace in the G7, Bank of England Governor Carney, he wants to raise rates too, but the when is still a big question mark there. Oh, well, what about oil prices? They hit new lows last week and immediately turned around and bounced back by almost 30%, getting almost to the $50 level yesterday, but today down another almost 9% back to the $45 level. So a lot of volatility in oil markets as traders try to figure out what happens next as far as the supply and demand equation. Well, remember, all of what we've been talking about here means that for the foreseeable future, we're going to see low economic growth, low earnings, low commodity prices, continued low inflation, and likely continued low interest rates. And that means that we are going to stay in this low return environment, and it's something that investors need to adjust their expectations for. We've been going on about this a bit over the last few calls, but it's certainly a key theme for 2015 and perhaps beyond for a while anyway. Well, we weekly talk about how we're positioning our portfolio models based on our assessment of the current environment, and there's not a lot changed, although there are a few small points to make here. In our fixed income model, we generally have 3 concerns. The first is interest rate risk, which is what the future direction of interest rates will be and how they might affect fixed income assets in the portfolio. We're also concerned about duration risk, whereabouts on the yield curve we need to be positioned. In Canada at the moment, we have some early signs of potential economic strength coming out of June, and that means that the Bank of Canada may not be anxious to cut rates any further. Again, as I said earlier, we'll see what decision comes next week. But at this point, with core inflation in Canada running at a level of just a little under 2.5%, we're pretty reluctant to go and purchase bonds that yield 1.5% because that means that we're actually giving up return after inflation. So we bought bonds back in May at significantly better prices and better yields. So at this moment, we have very little desire to add to that position. Finally, we also have to be watching the quality of the bonds that we own. as also known as credit risk. There are we want to make sure that the companies that of bonds that we're going to be buying are going to be able to make their interest payments and repay the principal. Of course, this is crucial, and we spend a lot of time on this, especially with our high yield holdings, where we do see some potential opportunities developing, but at the moment we remain vigilant. Preferred shares, I've talked about them in the last few weeks. It's another one of the fixed income asset classes that we'll invest in. We've watched preferred share index suffer on the back of lower interest rates and the fact that many of the higher yielding issues have been matured and been replaced by lower yielding issues. The fixed rate reset preferred share issues are replacing the once popular and higher yielding perpetual preferred shares. The lower return environment has impacted this asset class significantly, but there are still some potential higher yielding perpetual preferred shares available, and the prices and yields are starting to look very attractive. This is an asset class that is clearly underperformed. It is one that should be bought as part of any rebalancing. We reduced our exposure to preferred shares in April, but now we're currently looking at adding. So, but we don't want to own those fixed rate reset preferred shares. We want to own perpetual preferred shares, and that's something that we're going to continue to monitor as well. Well, in our global equity model, volatility has spiked after a brief respite late last week. So again, we have to watch closely to see if and when this might present some buying opportunities. But certainly we continue to have our disciplined approach working to make this determination. So much for the dog days of August. Now we are into historically the most volatile month of the year for financial markets. And what's been going on? Well, in the U.S., the long-term trend, uptrend remains intact, but we've certainly seen correction, and this could be a short-term thing, although it may be a little longer term. But year-to-date, the S&P 500 is down about 4.25%. In Canada, the TSX broke its uptrend a while back, so again, we're keeping an eye on that. But year-to-date, the TSX is down 5.25%. Japanese equities, they've finally started to correct. The uptrend line is still intact, and Japanese equities on the year-to-date are plus 8.25%. UK equities, they've continued to move lower year-to-date. You can see down 4.5%. Euro stocks, as I said earlier, are up on the year, but definitely below the lows that they set during the Greek crisis in June. So they've been erasing some of their gains more recently. Australia down 3% on the year. As for China and other emerging markets, China Shanghai Composite is down just 1% on the year after a significant spike and then pullback. But emerging markets are down almost 17% in U.S. dollar terms. Now, interestingly, the ETF we buy for our clients is actually little changed on the year so far. So all things considered, that's not a bad situation for, even though emerging markets are a pretty small portion of our global equity portfolio. All in all, our High Rock International Equity Model is down just around 0.5% on the year, which all things considered, again, is probably okay. Well, there's nothing new to add on the Canadian growth equity model. We still are following opportunities closely, but we haven't added anything recently. As for our 60/40 portfolio, which is a combination of all three of our High Rock models, it is up approximately 2% this year to date as of the close of business yesterday. Well, that's it for today's discussion. we're now going to open it up for questions. If anybody has any they'd like to ask, please feel free to come forward. All right. If you do have questions and wish to email us, we would be more than happy for you to send them. We certainly got some good feedback after last week's call, so please keep it coming. What you think is important to us, and there may be things that you want us to cover on these calls that we're not, so please, again, feel free to let us know. Okay, that's it for another week. Thank you for taking the time to tune in. Have a great week, wonderful weekend, and we shall return with another webinar next Tuesday. This is Scott Tomlinson signing off.